So for fund managers, especially institutional funds, returns is something also important to be delivered to the beloved clients, right? Everyone is just looking at, within 1 year, how much return you can generate and stuff. By generating the kind of returns, of course, you need higher conviction on the company. And the conviction actually comes from how well you know the business. And how well you know the business, actually, one of the process is to know the management also, right? So, and of course, it actually gives you a more of a shorter term of the sense of a shorter term movements of the share price in order for you to generate the alpha. But of course, I won't say that.
Before we begin the podcast, have you gotten your free ebook? It's called the Build a Six-Figure Portfolio Guidebook. Now, inside it, we share with you the tips and tricks to bring your stock investing skills to the next level. The best part, it's only 10 pages long and it's totally free. Whether you're on Spotify or YouTube, the link to download is in the description, or you can go to www.firl.co/FREE or www.firl.co/free.
Hey guys, welcome back to the podcast, best place for long-term stock investors. Today, we have, as always, a special guest. If you've heard of Mr. Ng Su Han, then you'll definitely be interested to know this guest as well, because he is the CIO of TradeView Capital, a good friend of Hans. You can say, partner in crime.
Fair enough.
Right. CIO. In a former life, he was also a fund manager at banks and all that.
Yeah.
But welcome to the podcast.
Thanks for having me.
Is this the first time you're doing like a podcast or this sort of interview style?
Yeah, I can say so.
Yeah.
But this is more of a casual setup.
Yeah.
Usually we're more professional, like on the stage kind. So yeah, so it's totally fine then.
We're not. But they have no pillows. We have pillows, right? So I think everybody wants to know, including myself actually. We like to get a sense of where you came from and how did you get into the fund management industry? Was it something that you always wanted to do when you were young, or that came a lot later?
Okay. In short, to the question is no. I mean, it came later.
Yeah.
So I graduated from Australia under this accounting and finance degree. Then once I come back, the only aim I was going to go for is actually to look for a job in a bank, right? Obviously, investment bank. So then my first job was in one of the back office in a global bank, HSBC.
Okay.
Yeah. So I started there and then I stayed there for about a year, mainly in charge of settlements for fixed income and also equity related securities, particularly for Hong Kong market lah. So that's why I got this opportunity to actually been seconded to Hong Kong for about 2.5 months.
Okay.
Just trying to learn their stuff. Then they're actually going through the migration phase lah. Bringing the process from Hong Kong back to Malaysia is more of their cost cutting measure also lah. I would say. Yeah. So up there about 1 year later, I decided to say no, this is not what I'm actually looking for. But it's more on going to the front office, right? Doing more investment related stuff. That is when I decided to move on and look for opportunities in the front office, which particularly ended myself up in corporate finance. Yeah. So and I consider that as part of or the start of my journey in the capital market. Yeah. The back office, yes, it was part of the equity market, but it wasn't really the frontliners.
So what sort of deals were you doing? I mean, were you doing deals during your corporate finance days?
I was just in charge basically as an executive. Yeah, so I was helping out the team. The team that I was into, basically in charge of M&A, mergers and acquisitions. So it actually involved a lot more on, like, say, takeover deals, generally like general offer. Sorry, yeah, general offer. And then some like rights issues, and then I didn't actually, did I? Yeah, I didn't take care of IPOs.
Okay.
Yeah, but mainly on takeovers lah for that time. That was around 2012 when market was still quite active. Yeah. So there are a lot of takeover deals here and there. Yeah.
What was like your big learning lessons in that period? I think that's an experience that most people won't have, right? Like, dealing with all these corporate exercises, things like that.
Well, I consider myself not so detailed person per se at the beginning. So the challenge was that to actually walk through all the requirements and the guidelines. Yeah. So as you are aware also that corporate finance, we got to take some of the tests or exams under SC.
Yes,
particularly give give advice, corporate advisory role. So to actually be better in that role, we got to know in and out of certain guidelines that applicable to say deals that we are preparing for clients. So we give advice, which line or which rules is not or is allowing you to do certain things and stuff.
Right.
Yeah, so to structure corporate deals with the clients. I mean, we are freely giving advice in terms of what sort of fundraising routes that you can go to, and then advise the clients on the options and give them the most effective or efficient way on raising funds. Yeah.
Is it as high stress as I think most people think? Because all this corporate finance or investment banking stuff, it's like long hours.
That was my first thought when I had the interview with the management for the corporate finance division. Corporate finance.
This was still in HSBC, right?
No, that one is Ambank already.
Okay.
Yeah. It is a gorgeous, what do you call that? Glamorous division of investment bank, because basically you deal with all the listed issues, listed companies issues, and of course in people's mind is that we are like higher level than normal auditors or other account professionals. But in fact, when you are starting from low levels executive, basically what you are in charge are more towards drafting prospectuses, drafting documents. The
coolie work.
So long hours.
Okay.
Yeah. So especially that year when I went through 2 to 3 general offers deals. So
this is like a takeover, right?
Yeah. So timeline can be very, very short, and we are required to work over weekends, kind of thing. Yeah.
Yep.
So it's one of the challenges would be the long working hours. Yeah. Then another one would be to learn all the guidelines and make sure we don't miss out any single rules or restrictions that the clients cannot carry out certain things.
But at the same time, also making sure that you can get the best deal, right? That you can,
Correct. Right. So then, not just that, but traveling is another thing, because when you handle things for clients and you have to deal with all your, they call it due diligence working group. So you basically deal with parties like lawyers, accountants, and then sometimes it involves valuers. Then you have to travel to either sites or to the client's office, and then you always have this meeting called verification meeting, meaning you drafted something, then everyone verify information in the documents. And that's when everyone gathers together and walk through things.
Is this something like, so-and-so claim that they have a factory in Vietnam, so you go to the factory in Vietnam?
As much as you wanted to go overseas, but of course, they will actually send all the valuers report for us to have a look and stuff. Before we really travel there. Unless necessary, if value of the certain assets involve a significant size of the company, then no choice, we got to really go there and have a look and really make sure that things are really in place and things are really real.
Do you think now with video technology and all that traveling there is not necessary anymore? Like if you want to check the inventories, let's say, you can show a video. You think that works, or it's still pretty traditional where they have to go back and check everything?
My personal point of view is that you got to go to the traditional way of doing things.
Right.
Because the virtual site, So I mean, especially given the higher standard of our regulators who wanted something more. I mean, they are more of the prudent side and also conservative side. They will make sure that things must be all in place. You know,
Right,
it must
right.
be really like taking photos and stuff. So to make sure that things are really real. You know, but virtual wise can be sometimes. I wouldn't say the virtual is not effective. I mean,
Right.
in fact, it's time effective, but it also has their flaws. You know, sometimes videos. I don't know how trustworthy they are. You know, but maybe things are just
Maybe you need
going-
FaceTime. FaceTime, right? Here's the
so
side.
I think my personal point of view is that they will still go through the traditional
Right.
way of doing things lah. Yeah. So throughout the corporate finance environment, I got to know like how listed shares or listed issuers are dealing with things or transactions. That it's when, to answer the first question, is that is when I kind of be more involved in listed companies and when they talk about share prices. And then it's like when I started looking into more of the stock investment side.
I see.
Yeah, because previously, before entering into the job market, what I was exposed is basically more on those plain vanilla products. You know, like every one of us will be aware, like say unit trust, currencies, you know, or even real assets like property markets, you know, and FD. You know, because last time, just to sidetrack a little bit. Family wise, they had their own time in stock market investment, but of course, 97 crisis was somewhat scarred then.
Then they swore it off. They
So
didn't
yeah,
wanna
in
go
a
back,
way, that was somewhere. I mean, that time during the crisis, I was standard one. So basically, I didn't really hear a lot about stock investments from the family point of view, lah. Yeah, so involvement on that front also a bit lesser. Until then, when I started my college or uni time, then I only have this kind of knowledge, and when really come into the job market, then it's when the real life example come into place.
Right.
Yeah, that's how I got into more of the stock investment side.
So obviously, you know, with corporate finance, it's very similar transferable skill set, but it's more directed to, you know, finding the best deal for the firm.
Yeah.
But did you transition into fund management or equity investing or whatever word right after?
Yeah, great point. From corporate finance, after about 1.5 to 2 years, then there was an opportunity in the same bank, the private banking division. So there was this analyst role that was open. So I gave it a try. So I talked to my bosses. You know, I said I would want to go ahead and try that position out. Then I did. Actually, I went through the internal process to private banking.
In the same
In the same
Ambank
banking group. Yeah.
Right.
So that is when I started looking into not stock yet, but I was a portfolio analyst, meaning I actually analyze unit trust. Yeah.
Oh, okay,
Correct.
okay.
So it's a different kind of analytical matrices that we use for portfolio analysis. Yeah.
what's different?
Well, when you look at portfolio, that's when you study number of stocks within the portfolio, and you actually come up with ratios like Sharpe ratio,
Yes.
expense ratio of the portfolio, and then you interview fund managers, right? And to understand what's their investment philosophy or the way of them investing. And then also we look into tracking errors, you know, also all that sort of ratios,
The
rather than
returns
stock.
calculations not too accurate, things like that, is it?
Yeah, it's not really that accurate because we only relying on available information on
Yeah.
the public side.
Yeah.
Unless the fund managers share more about the
Yeah.
stock holdings and stuff, but which typically they do not. So
Right.
we can only rely on historical data and hope and make an assumption like say they hold these stocks for a longer period of time, more than 2-3 months kind of thing. Then we have the full list. Yeah.
So it sounds like auditing, but for internal, it's an internal audit for funds.
In a
fund
way,
house.
because
in a way,
private banking side, we have clients, high
Yes,
net worth
yes,
individuals, and they are also interested in buying unit trust. But the thing is, which one? So
Yeah.
they will ask. Then we come up with all these ratio analysis just to make sure that there is some sort of comparison made on which portfolio which is the preferred one than the other, and you know, to recommend to them.
But I mean, that doesn't quite sound like what you wanted, right? You maybe
Yeah.
wanted something more equity
Correct.
investing. So that, how about that transition?
Okay, so of course, private banking division, besides this portfolio analyst role, there was also equity analyst and fixed income analyst, and also alternative asset analyst. So those were filled last time. So there were some other people looking at different kind of products which I was then only
Yep.
looking into unit trust. So the transition happened. It's when after a year later, I was like talking to the boss. I said, well, is that an opportunity internally that allows me to explore the stock investment side or stock analyst side? Then at that moment in time, because it was, I think, 2013, that's when the Bernanke crisis came about. So the tapering.
2013.
Yeah, the tapering. Yeah. So, market was very volatile and stuff. So it wasn't a chance for the company to grow at a faster pace, lah. That's why. But the thing is, that during that time, then I had an opportunity, lah. Basically, someone referred me to Public Mutual.
Ah,
Yeah.
okay.
Then I gave it a try also. So I mean, in short, I actually went over to Public Mutual, and that's when I started my role as an equity analyst there.
So I have to ask this question now that you mentioned Public Mutual.
Yeah.
Were you involved in like public small cap and the guys there? Or that's different? Because public small cap is one of the best performing funds, right, in Malaysia, I believe.
It's a really big team in Public Mutual, and they have duty segregation inside the team. So when I joined that time, they were basically having two big teams, fund management and research team. I will just put it this way. And whether am I involved in the small cap, I don't think I am, because I was in the foreign research side.
Okay.
Whereas the small cap one is more Malaysian centric. So I wasn't in the Malaysian team. Yeah, and I'm talking about just research team, but they have also fund management team looking straight into the stock investment side, whereas the research is more on producing research reports, recommendations for the consideration of our fund managers during that time. Yeah, so I was more on the foreign market side. I started with Korea, and then move on to Hong Kong, China, and then a little bit into Taiwan. Yeah, but of course that is the major one would be Korea and Hong Kong, Taiwan.
How is that like? Because I seldom actually come across people with a background such as yours, whereby they're looking at the East Asian players, right? Taiwan, using Hong Kong and Korea. What was that like in those days? And of course, it's also a new experience for you, right, at that point in time.
Definitely. I would say it's a very good training that I had in Mutual, whereby a lot of fundamental analysis, long-term ones, especially focusing on the quality of companies. I'm talking about numerical, that sort. It's not just interviewing management and get their insight, but rather we look into, say, fundamental of the company, like see how strong is the balance sheet, cash flow, is it manageable? And then when it comes about driving business expansion, what sort of cash needed or capital required, and that sort of thing. So it actually takes a while to make a recommendation, simply because we have to go through steps like analyzing the stock based on SWOT analysis. Then you also come up with your financial analysis, and then also you got to analyze the top-down manner in terms of the industry or sector, within that the stock it operates into. So I think it's a very good training process for me last time, and typically they actually take about 2 to 3 weeks to actually come up with a stock recommendation, and that is for long-term holding. It's not so much on
because this is buy side. This is buy side stuff, right?
Correct. I've been in the buy side, so yeah. So yes, the philosophy is really different, especially for bigger house like Public Mutual, because stocks that we invested into are basically more for a horizon of talking about 3 to 5 years. Yeah, unless there's other concern like liquidity concern
Of course.
or small cap,
So walk me through. Let's say you you want to generate an idea. Now is this getting into? We'll get to TradeView and of course Kenanga later on, right? But now that you're talking about this, I want to get a sense of back then in public mutual, because I think a lot of people also want to know what the grind is like. So you would you have to prepare a presentation, I assume, for your superiors.
Reports, I wouldn't say so much on PowerPoint, but
Okay.
it's normal works.
Okay.
Yeah.
And so I'll ask a question at that. What needs to be in your report, or how should you write your report in a way that they would accept your report very quickly?
Okay, the acceptance comes from whether
They like you.
Firstly, like, okay, now if I'm a fund manager, right?
Yeah,
so
yeah.
when I see a report, definitely I'll look at how much upside is there in terms of target prices, But target prices can be subjective because it's all about your valuation and your earnings assumption and things like that. But it's just more like what captures your attention is that, what is your recommendation? And your recommendation comes with how much upside. It actually shows that your conviction on the stock, right? So other than that, I think reports in big house like public mutual, right? It tends to be similar to what's outside reports that you are seeing outside. Yeah, basically it involves a lot of angle on arguing your points within the report. So what to be included in the reports, like I mentioned, SWOT analysis about the company, what is the strength and weaknesses of the company. Then after that, you look into the macro environment side, what is the opportunity and threat. And then also sometimes you also do consider Powell's 5 forces. So we actually do look at their suppliers and the customers, right? Then we also that is actually a baseline to determine how you actually come up with your revenue assumption or your earnings assumption. What sort of why there's a cost savings element inside. That it really come back to all this basic.
And that's the quantitative aspect of things that you were talking about.
Yeah, more on SWOT is more on these two are actually more.
It's actually a marriage, right, between these two.
Correct. So once it's all done, then it actually goes to the numbers straight away. Like, okay, what sort of assumption you put into top line and your bottom line, and why it's actually justified by all these points.
Right.
Yeah. So this is just part of it. Then after that, you also have your risk and catalyst analysis. Like, not so much of analysis. Just point out what is the growth driver going forward. Like, what sort of things that you look at.
Yeah.
That moves share price.
Yeah.
And why do you recommend it now? And then you actually come up with your valuation and recommendation. Maybe because valuation is low, or is it on peer analysis? You actually compare with other companies within the same sector, and then you come up with some sort of comparison. Then that actually more leads to the recommendation already. But of course, that time we also involve a lot of ratio analysis. Basically, you look into their quick ratio, current ratio, and then all the debt ratio. Then to justify whether it actually leads you to a more holistic recommendation.
So I want to talk a little bit now before I move on your experiences with Korea, Taiwan, and Hong Kong. Yeah. So obviously, I think most Malaysians don't know, including myself, don't know much about these markets. Taiwan maybe a little bit more because a lot of our companies are linked to Taiwanese companies. We have Taiwanese companies here also.
Yeah.
So what were some of the interesting discoveries you made when looking into these three markets?
Okay, let's start with Korea. Right? Korea is actually pretty much a retail-driven market.
Interesting.
Participation of retail market generally you are looking at 60 to 70%.
Whoa.
Right. So a lot more on news flow driven investment. So basically, the investment in Korea cannot be too long.
Really?
Yeah. You're either looking at 6 to 9 months horizon, or sometimes it can be as short as just two quarters or less.
Wow.
Right. Because it's all about thematic driven story, news flow in Korea market, because it's retail market. Yeah. So generally, like, after 2 weeks, then they will have a new team that say, okay, now everyone is looking into, say, EV team, or now everyone is looking into, say, consumer cosmetic team. That type of changes in terms of news flow that will actually affect share prices movements. Yeah. So foreign investors tend to look at just the bigger names in Korea. So like Samsung, LG, Hyundai, all those that is well followed by
the chaebols.
Yeah, the chaebols, correct. That is Korea. Then that's why sometimes when you look at valuation of Korean market is generally low because there's a high discount being imposed on stock valuation.
Because of the makeup of the market lah.
Yeah,
Right,
the makeup of the
yeah.
market, and then also the shareholding structure of all the chaebols because they have all across shareholdings. So
Yeah.
basically, you are looking at one team like say, or Samsung will be benefited by mobile sale, but of course they also hold other stuff. So that generally it will be diluted somehow, in terms of earnings and things like that. So there are some discount in terms of stock also.
And
Then governance also.
Is it fair for me to say because it's more retail that the volatility will be a lot higher?
Yep.
Right.
Yeah, you can conclude that for Korea, and of course there are also a lot of governance issue lah in Korea market. So off and on you will hear like companies labor go on strike. Then on and off you will hear like this company buying into something unrelated to the business. Then so on and off you will hear like product has faulty,
Right.
or some security issue, all this. So typically you see all these elements in Korean dramas. It's all
Which is
there.
actually happening.
yeah.
And so,
Yeah,
but then you know the reporting and all that. Like, did you have to learn some Korean?
no,
Hangul.
I mean all the management meeting comes with a translator for foreign investors. Yeah, unless the IR, like say Samsung, they don't need because the IR itself, himself no English.
Okay.
Other than that, smaller companies they will have a translator all the time.
So
Or
you were traveling there quite a lot to Korea.
Yeah. Last time about maybe 2 to 3 times a year. Yeah,
I see.
I mean it was mainly attending the conferences, but once or twice will be just organized on our own. Yeah.
Right.
So there is more.
Right.
in
So
Korea.
that's Korea. So how about the other two?
Hong
and
Kong,
Taiwan?
China side, actually the market started to open back in I would say slightly before 2000 lah. Year 2000. So that's why during the time when I started looking into the market, it's actually more of a growing stage. Yeah. So a lot more investment opportunities. Yeah. That's why more vibrant, I would say,
Okay.
in terms of even coming up with number of stock ideas in China. But one thing about China is that it could be a lot more political because a lot of the companies are still considered sovereign owned companies. So government
That's
has
SOEs
some
are,
say.
right, they call it.
The companies are influenced by decision of the government. So and then another thing about China is the regulatory risk. Yeah, because as I said, SOEs and not just SOEs, but generally speaking, the government will come out with a lot of new policies, trying to achieve their own agenda.
Yeah.
So the latest agenda would be common prosperity. So basically, government will impose things on companies that grow too fast. Just want to make sure that everyone enjoys it. So it cannot be outgrown over another. That kind of reasoning behind. So that's why Hong Kong, China, we got to really understand the history of China, which I personally do not claim that myself to know a lot about China history, but by knowing China history, it helps you a lot in terms of analyzing their behavior on companies, and that's when it helps on stock investment in China. So I would say China. So Hong Kong, China. Okay, China, which is local China, but Hong Kong side has more international exposure of for companies who is listed in Hong Kong. So that's why generally we will be more interested in the companies or China companies listed in Hong Kong market because that's when you have higher foreign participation, higher following, and then more transparency and also accuracy in terms of numbers. Yeah.
And so, I think last one is Taiwan, right? I know Taiwan is a dividend haven, right? A lot of...
They have their own dividend culture, dividend paying culture. I think it's also one of the requirements set by the Securities Council there. But the thing is, something interesting about Taiwan is that each single segment in the supply chain of technology will have a listed company. That is something that is unique for Taiwan. Like say, PCB board, you have someone in charge of that, and it's listed. And then the material of the PCB board
Will be there as
also
well.
will be listed there. So each chain has their own leaders, when it comes to
This whole ecosystem
Taiwan.
there, actually.
Correct. So a lot more niche market for Taiwan, but at least it gives you certain exposure in terms of, not just particularly concentrating into just like one that represents everyone, but at least you have some diversification in terms of number of stocks in Taiwan that you can hold within a chain, So not necessarily you must hold just TSMC because it represents everyone, but within the chain itself, you can hold like other companies, smaller ones, and that diversify risk a little bit, but at the same time, the growth profile also different that can gives you a different kind of alpha.
Yeah.
So it's a really different and interesting market, Taiwan.
Okay.
Yeah.
So moving on now from your experience in public mutual, was it Kenanga next straight away or?
Oh, then I returned back to the same division I had in Ambank.
Corporate
That is
finance?
No. Private banking.
Private banking, sorry. Yeah.
So that's when my ex-boss was telling me that, now there's an opportunity here in the stock division, and there's a portfolio for you. So basically discretionary portfolio where you in charge of managing clients' money by investing into stocks. So I was like, okay, then I gave it a try. So I returned back to Ambank for that role.
Okay.
And I stayed on there for about 2 years before I move on to Kenanga. Yeah.
And when you were at Ambank, you could, in those 2 years, you could actually, what's the word? What was your mandate? Was there a mandate?
Oh, private banking side mandate is Asia mandate, Asia ex-Japan mandate. Yeah, total return, absolute return fund. It's not relative.
Right.
So as long as there's it's pretty similar to what I have now in TradeView Capital.
Right.
Where all the discretionary mandate will have a certain hurdle rate. Yeah, and you will have to achieve higher than that to enjoy some sort of
Performance
sharing
fee,
on performance fee. Yeah,
Right.
Yeah. That is typical structure of a discretionary portfolio, and mostly it's for high net worth individuals or even corporates to a certain
And
extent.
I mean, it sounds like was a pretty good deal, right, at Ambank, but yet you decided to move into Kenanga.
Oh, it was just natural because that's when another one who actually approached me to join Kenanga because there was this opportunity there, and private banking last time wasn't too bad. Of course, but it's just that the company has been on a restructuring mode as a whole banking group. If you talk about Ambank, that's when people relate to compliance risks. Yeah, so a lot more scrutiny on things that we do,
Right.
and may not be too beneficial to business. That's why maybe the growth wise in terms of client incoming funds is not as great. Yeah, so that's why an opportunity comes from Kenanga where I think that that actually can drive me higher in terms of personal management on the size of AUM.
I see.
Yeah, AUM and asset under management. Yeah, that gives me a better profile there. So that's why then I move on.
So, like at Kenanga, was it the same mandate as well? Asia.
Kenanga is as a whole, Kenanga is more of a Malaysian centric fund house. Yeah, so but I joined Kenanga as a foreign analyst to begin with. Of course, slowly then I got assigned with some portfolios which are mostly also Malaysian focused.
Right.
That's why that is when I am more focused on the Malaysian market.
Right. And
Yeah.
so, do you remember what it was like when you transitioned from foreign to Malaysian? Like,
I think it's a different skill set in terms of analyzing companies locally versus foreign. Okay, the difference is that because we are not on the ground, so we rely a lot on sell side brokers when it comes to foreign companies.
Okay.
Yeah, so we don't get to see the management directly. All the time it will just be conferences or even whoever who follows the company closely, which is the broker. So we actually rely more on our conversation with the analyst who covers the stock, or sometimes we just are able to talk with the management when there's certain meetings that we organize with the foreign companies. But whereas in Malaysia, it's a more defensive market, I would say, because defensive being a larger pool of the shares or volume has been held by our GLCs.
Yes.
Right. So liquidity wise is lower, right? And then retail participation at one point was also low, right? So then without retail participation, then the trading volume also tends to be lower. And it's all like controlled, not to say controlled, but it's more like held on by institutional funds. And when you analyze Malaysian companies, right? Firstly, of course, typical skill, on analysis is there, like following how you analyze foreign companies. But of course, we got to also pay attention to who are the shareholders. Different shareholder profile will have different sort of I wouldn't say movements, but it's more like following the plan on the stocks lah. Yeah. So if it's like a larger company with higher foreign shareholding, then sometimes the question being asked by the investors on the company is a lot different from a family-owned company. Yeah. So like giving it as an example is that if you are if you are looking into a family-owned company, then the first question you will ask what is your plan for the next 3 years on driving your business, right? Is there like any reason for you to raise capital and that sort? That leads to another question of whether there's a fundraising exercise. Whereas if you are looking into a large cap company, then the more is that you are asking whether is there a dividend policy, or then would there be is there a movement on foreign shareholding trend? Is it like coming down, and why? And is there something that people are seeing that we are not seeing? That sort of thing. It's more of a herd mentality rather than just focusing on the stock itself. So there's one of the example, but there's still a lot of aspects that we look at. Yeah. And then also that since we are on the ground, so technically it gives us an upper hand than foreign investors when it comes to Malaysian market. Yeah. So that differentiate myself back in the days when looking into foreign companies versus now I am a lot more closer to the companies under my coverage. That at least I can actually straight away give the IR or the management a call and to set up a meeting, to find out about things, just like that, rather than I have to wait for analysts to do the job,
Right.
Yeah. So I think the information access can be quicker for whoever on the ground. So I would say that it could be the same in Korean market. If I was in Korea, so basically the analysis would be the same like how we see Malaysian market right now. So I think that is one of the differences. Another thing is that it also the market capitalization of Malaysian market tends to be a lot smaller than foreign. So foreign shareholding also not as high. So that's why that actually translate into lower trading volume for Malaysian market as a whole. So that's why sometimes we got to also ask the essential questions on how, can we hold the stock for long-term basis? Is it like for the next 3 years, if there's any issue or not, that sort of things, we should ask all these questions, even though, for all the markets that we cover, but I think it's particularly in Malaysia, it's more like whether we can build position in certain companies, and would that worth our time looking into that? Is really a lot more to do with management plan already lah. Yeah,
Right.
Correct.
So I before I go on to TradeView, I want to get a sense now, because you've gone through many different experiences, and you know what, maybe let's go straight to TradeView, right? So this was set up, I think, in April, right? You all got your fund.
We got our license on the 31st of March, end of March. Yeah.
Right.
Then we started operating in April. Yeah.
Right.
And then we have been setting up the company for about 2 months just to get everything up and ready.
Right.
Yeah, to collect funds from clients. Yeah.
So what is the overall strategy for like TradeView? How do you guys, because now you're obviously in a different position from when you were Last time, either you're an analyst or at the highest you could go as a portfolio manager. Now you're the CIO. And so what is the investment process like for TradeView? How do you find ideas? How do you manage risks, things like that? And working also with other, working with Han, CEO, working with other analysts and portfolio managers as well.
Sure. I think it wouldn't run so far from the way we the usual fund management company is running their business. So, but of course, a smaller setup like ourselves, it gives us the flexibility on implementing certain investment strategy, and especially given the asset under management right now is not big yet. So it actually gives us an upper hand in terms of how we decide on our investment or what sort of stocks that we can invest.
Right.
Yeah. So main focus for now of ours would mainly still focusing on small cap to sometimes you can call it micro cap companies. Some that it's out of the radar of big institutional fund. Yeah, because of liquidity concern. So that's why some companies they are good companies, but it's just that they are too small. Either they are too small or just that they have been lacking of attention from the investors. That's why they are also not paying attention too much on how the capital market, price their company. So the way our approach to these companies is that we will actually try to understand where they are coming from first in terms of running their business. If there is some sort of potential or even the cash that you're holding. I mean, of course, companies that we select are pretty healthy in nature, like especially with some companies that has high cash holding, but just that they are not doing anything with the cash. So then we got to further understand these companies. Are they having any plan going forward? If they have not, would they consider any inorganic growth, any merger, or any opportunities going forward? If they are also not doing, then they are. So we will ask the question so would you return cash to your shareholders, that sort of things? Yeah. So I think the process in terms of evaluating a stock is pretty much similar, or in fact the same. It's just that the targeted companies that we are looking into is just different from what other big houses are looking into.
Right.
Yeah. So that tells one of the differences. But in terms of running the business together with a great team, Han and also two fund managers of mine, then it gives us a lot more flexibility in terms of how we decide on investment. Flexibility in terms of timing of execution. Yeah, because a bigger house, you may need to go through certain investment process that takes time to develop because I mean for the good reason, it's actually the due diligence process that you go through just to make sure that you have ended up in a good investment. But also it's the same, but it's just that in our house we get to implement things faster. Yeah, because of a smaller team, we can just sit down straight away after I've written a report. Then let's gather for the next 15 minutes. We talk about this, and if everyone agree and there's no disagreement, then we just include that into investable universe. Then we can start executing the trade.
And that is it's a consensus model, right? Remember,
it's a consensus model. So every one of us has to discuss on the stock recommended by each of us. Then after that, it will have a sort of healthy discussion. Like if there's any disagreement on certain points, then we'll bring it up. At least there's no hard feeling. You just have to throw it out and say, if I don't agree, why? Then if I agree and continue, then how much weight we increase on certain stocks. Then everyone agrees, then okay, let's execute it. Yeah.
So what are the filters that you typically have where you talk about the investable universe, right? So that implies that there's like a ring fence, right? So what gets in or what goes out? What cannot get in?
Technically, it comes back to the discussion point. So if everyone agrees to put it in, right? But how do we come up with the agreement? Basically, we evaluating points like whether we start from the balance sheet first, of course. It's
Really?
about
Okay.
whether this company has a balance sheet issue or not. Is gearing high, or is it having a lot of cash, or is there any contingent liabilities issues, or what goodwill, that sort. But it's just a glance. But other than that, we also cross check on the cash flow side. Do we see the healthy cash flow generation from the company? And if there's if there's a negative free cash flow, why? Is it higher capex, or is it because a negative operating cash flow due to declining earnings profile, or what? So we will actually bring all these points before we look into the P&L. The P&L is more like the share price driver. So it's like, okay, now we actually look at the income statements and what drives top line, what drives bottom line, and what sort of theme is that? Does it fit into any single theme, at the moment? Like, for example, at the moment, everyone is talking about reopening play, then after we analyze on a bottom up basis, does it company fall into any of the active theme right now in the company? Or that actually determines whether the timing of execution, would it be now or later, that sort of thing. So if there's any of this during the process where there's some disagreement, like say, I don't think the balance sheet is healthy because there may be some other points that I missed out, or maybe my other fund managers, they actually have been covering certain sector or even has better knowledge in that company. Then they will voice out, I disagree because what the receivable is high, or because what they may have other additional knowledge in terms of maybe they are executing plans that we are not aware, then there could be a potential that they actually misuse their cash. These are the example, right? To at least prevent the inclusion, or to at least highlight it as a risk before we include it in the universe. And when we include in the universe, also based on the timing of execution, if let's say we do not plan to actually buy the stock or sell the stock, right? So we will actually hold it back and say, okay, why not we keep in view, and
So watch list.
yeah, and then we come to revisit once things are more actionable. Then that will be more of non-inclusion for that time being.
Right.
Yeah, so that is more for the inclusion. And basically the universe is actually more of a formality and also a requirement that is set by SE to actually make sure that we discuss about things that we invest into, and also has a proper check and balance on our actions as a fund manager. Yeah.
And are you all a single asset or multi-asset right now?
Single asset at the moment,
Single
it's just
asset,
equity.
okay.
Yeah.
Okay.
Cash is all in money market. Yeah.
Okay.
So of course, that is when for stock discussion, but we also have our asset allocation discussion, meaning we also sat down and then things about more of a top-down approach, like say what is going on in the macro level of things.
Yes.
And then we decide whether should we be more defensive, should we be neutral, or should we be more aggressive and deploying cash.
Right.
So there's another discussion on that.
And how does the top-down approach look like? What are the things you look at? Right. Are they
I think it's a lot simpler when it comes to top-down. Basically, you just watch on any. Of course, the activities in the developed markets right now, which is very active which is a US side. And then also there are also other global movements in the Europe, or even some of the part of the Asia market, which involves like say Japan or even China, right?
Yep.
So we actually highlight whatever we hear, we read, and during the discussion, and then when let's just give you an example.
Yes.
If let's say I think that US is raising interest rate too fast, but maybe I came up with a point and say, but the thing is, I think the stock market has actually priced that in already. So what else? What's next? Then another fund manager will actually come and tell and say that, but you shouldn't neglect the property bulls in China. That is also another macro risk. Not just US side, but that is more of affecting our Malaysia because they are one of the trading partners. I was like, yeah, I agree totally. Then that actually pulled back some of the positive stance I have just based on US. Then of course another fund manager can come in and say, okay, you shouldn't be neglecting too much of what is going on in the local market where there's potential general election coming in. The timing itself can also determine our entry point. So let's come to a consensus agreement whether we should be only be more positive later on instead of now. I mean, on one point, yes, we should be positive. Because things may seem to have priced in everything, right? Just based on US. But if you look into any other part of the world, that may be some other risks that actually would impact some of our investments. So, which I think that it's really a healthy discussion, healthy debate, so that it comes to a more of a healthy decision in terms of making an execution. Yeah.
Okay.
Yeah.
It sounds really, really comprehensive.
But first, this happens very fast. It's not like I have to sit down for an hour just to talk about things.
Yeah. Because you know each other already.
Yeah.
Right? You know each other, and then you can be more snappy, right?
Okay.
So I will go a little bit into go back into your history, which is actually the specific investments you made, either for the banks or whatever, or even but I think personally as an analyst, you can't invest, right? I'm not allowed to. It was very difficult, right?
But I made wrong calls before and made right calls before.
Of course. So I like to play this game, it's called top 3, right? So like, what are the top 3 companies, right, that you've like we say are your winners? And we'll talk about your losers later on.
Okay, winners. I mean, if it's winner, I wouldn't exclude glove sector at one point.
Yes.
Right? Because that was really making a lot of money for everyone. Whoever invests into glove sector for that time, back in 2020. For that duration, yes, correct. So I wouldn't say I'm the early mover when we take a position in glove sector, but I was a glove analyst, and at one point, things are just too moving too fast. But at the same time, it really has driven all the glove companies' profitability, which no one else expected that to happen. And of course, if you put into your financial model by just assuming certain things, you actually see that the earnings really, so that time it actually surprises everyone, including myself. It's like, I don't really believe the number that I work out. It's like, for a glove company, it hasn't happened before that you will actually have this sort of earnings profile that you can project. So there was a point, and of course, I also discussed with my ex-boss, and then we all decided to why not just jump the gun and invest into the glove sector, right? Given that things are just moving too fast, just by raising prices, and the demand just come in so quickly and so aggressive that no one can think about that kind. So during that year, we made quite a bit on glove, yeah. But of course, I am always wanting the team to actually take a step back and think about it. Like, is it moving too fast? Always be conservative and also be prudent in terms of your assumptions that you make. Are we too positive? Are we neglecting or miss out any points? After like 4 to 6 months investments, then we actually took a step back, and then I actually voiced out some concerns. It could be that valuation has trading too high. And because of what? Because everyone is just too aggressive in buying.
Yeah.
Then would the valuation come back down when vaccine became available, or supply came in, later part of the story. So that is when I begin to ask for a take profit, to recommend take profit. So why I say it's a winner, because we actually managed the exit quite good in terms of calling it a sell, than really holding it until a period of time later. So that is one of the winner that I can consider for myself. Then the other one is the technology sector in Taiwan. Yeah, so we made good money or profit from I wouldn't say just TSMC, but overall tech sector in back in 2020 and 2021, because that was when not many other sectors that actually gives you that kind of earnings growth, because all other sectors are basically being impacted by COVID, right? So during that 2 years, technology sector is the only one that has been consistently giving quite good earnings growth. In fact, it's structural because it's driven by either all the theme like AI, 5G, EV, even some to a certain extent mobile side, which is everyone going into work from home culture.
Yeah.
Everyone just drive higher demand for wearables, for PC, for devices, right? So I wouldn't say this is a significant winner, but I would say I did not lose out in terms of having an exposure in the technology sector lah. Yeah. So other than that, well, another example would be healthcare hospital, because it's in line with the pandemic environment. So basically, just having a thought that hospital,
Malaysian hospitals.
Yeah.
Really?
Malaysian hospital.
There's only 3 or 4,
I must say
right?
IHH.
IHH, okay.
Yeah. So it wasn't like a great not a stock that gives you like a glove kind of return, but at least it has been on a positive trend because of the COVID treatments.
And I mean, leading to the returns and all that, I remember Han giving an answer to this also, but do you all have a target return in mind? Like that you guys would consider good? What is good return? Because you ask different people, they have very different answers.
Yeah, I think it's subjective based on your risk profile of the company as well. But of course, generally speaking, the mandates that we have right now with the hurdle rate of 7%, right? So that is the targeted return for a year, right? So, but to consider a stock, at least if it's a buy, then we consider 15 to 20%, upside potential. That is, to us, is good. But of course, we just don't look at the upside, but we also look at the downside. But if I say there's a 15 to 20% upside, but actually the stock has risen for like 100 to 200% already. So do I consider that as a risk and reward attractive investment? I would say no, because the downside could be a lot more because, for all sort of reasons.
That's true.
Right? So generally speaking, if it's just looking at upside, then 15 to 20%. But because that is something that leads to achieving the hurdle rate. But of course, we also be prudent and then managing our risk a little bit here and there. So we also consider downside.
Right.
Yeah.
So speaking of downsides, right? The 3 worst investments you made in your life, for yourself or for other people?
For other people.
Yep.
Okay, one of the idea I came from Korea market, where maybe because I was new and then I neglected certain points. Basically, I actually made recommendation on one of the company in Korea that produce specific product, which is related to supplement market. And the company is only relying on that product. And the product was the best seller ever for 1.5 years, And why I say it's a bad investment, because there was that, you remember just now when I said Korean market has a lot of news flow.
Retail, yep.
Yeah, so there was a news article that came out and said there's faulty and there's risks on the product. Yeah, so basically, it just took away 90% of the market cap. In 3 days.
90%?
Yeah.
Wow.
So every day just limit down, for 3 days. That's exactly the collapse of the company. Yeah, just because they have issue on product, and the product is related to I wouldn't say FDA. Okay, the Korean FDA side making a statement that say they will restrict selling of this product. So basically, the company's life is just gone. Just relying on the single product, right? So that actually taught me a real good lesson, is that maybe companies with specific product, I would not really consider that much because of the concentration.
Right.
Yeah. So concentration risk to me after that incident is, to me, actually quite a good warning, or quite a good sign when it comes to own investments. Yeah. So like not just product, but if you have a single customer or you have single market, that depends on number of customers or suppliers that you have for the company. But I wouldn't be putting my eggs into just company with specific product, although it's just best selling product, but the risk, towards the product is high lah. I mean, of course, when it comes, when things have grown big, that's when you attract a lot of unnecessary noises, I would say, or attention to what sort of product, what sort of customer, or what. Just people may be jealous about the growth of the company that they want to just hit you.
That's crazy.
Yeah. So yeah, that's one of the lessons that I learned from that.
Are you at liberty to share the name of the company?
Well, it happened many years ago. I don't mind. It's actually called Natural Endo.
Natural Endo.
Yeah, in Korea. Yeah.
Okay. All right, next.
Okay lah, I wouldn't consider else it's worse, but they just didn't meet the investment thesis that I recommended. So basically, the company just go the other way around so it's basically bad recommendation. One of the example is one of the consumer idea in Hong Kong, China. It's an e-commerce lah. It's an e-commerce idea. So back in future days, I actually look into Baba.
Alibaba. Okay.
Yeah. So but there was a short period of time when Baba I would say Baba, but it's more like there are news saying that Baba is actually selling for what do you call that? Not faulty goods, but fake goods. Yeah, so it's a customer who is posting all the fake products on website.
I remember this.
Yeah. So of course, that is also affecting the share, the sentiment of the shares, and then but we made quick actions and exited Baba a little bit, or trimmed down the position a little bit. Yeah, when it comes to that kind of news. So of course, Baba has its potential later on when you can actually see Baba has grown so much.
Yep.
But during that time, it was because of an event, because of certain reason for that few months thing that it actually didn't make me a good recommendation for Baba. So that's just like that. And there's one of the example, like I wouldn't say worse, but just bad recommendation. Yeah. They don't really lose money per se, but I think losing money is more on macro-driven reasons lah. Like because we are all stock pickers, we are not like really good in reading a lot of macro data and stuff. I mean that of course we rely on a lot of economies and the brokers' recommendation, but generally speaking, what actually leads us to not making so much return is basically more on macro side lah. I think generally the theme in TradeView Capital is that every one of us are good in our fundamental analysis. Yeah, just I think to answer your question, not so much on stock per se when it comes to
it's the factors that is the external, the exogenous factors. Correct. The fancy word. Right?
Correct.
Right.
Yeah.
Right.
So
okay, last bad investment. So you mentioned Natural Endo and then this Alibaba and then
okay, let me think.
Not many.
No lah, just maybe just another one in China, which is the telco sector. Well, I actually had a overweight on telco sector in Hong Kong, but it's just that SOE being SOE, the company's direction is driven by the government's policy.
It's a Chinese company listed in Hong Kong lah.
China Mobile.
Oh yes. It was I was looking at it before, and a lot of people got drawn to it because of like the dividends and the valuation.
The expectation of a special dividend is because of the high cash holding that they have. They'll be expecting that the dividend angle to come through, but it hasn't. And then another thing is that because there's also not scrutiny, but more on higher attention from the government on how you fix your mobile charges. You try to just ask you to impose basically to ask you to lower down on the mobile data charges. So it actually affects the telco sector and not so much on my thesis doesn't work out. It's just that my thesis is based on things that I can see like higher cash flow, higher cash, meaning I will expect you to pay more higher dividend. In fact, the company is also giving some guidance. It's like, oh yeah, we'll consider that, things, but it doesn't come true means it doesn't come true, right? So and of course, geopolitical side of things, actually China Mobile is about 10% to 12% of the China index, right? So whatever hits China, it will hit China Mobile also.
Yeah.
Yeah. So
fair
that
enough.
recommendation, I think.
I want to talk about your views about macro later on. I know it's not something, I guess something in development for you guys, right?
Yeah.
To develop that, because I think, anyway, a little bit more on that later on. But just before that, I want to get your thoughts on diversification. So what is the policy? Because we've spoken to Han before, right? And he is a 20 stock guy, right? He likes 20-25 securities. If I'm not mistaken, 15 to 20, something like that, securities in his portfolio. And he has this concept of he likes balanced portfolios, right?
Yeah.
He likes to have some in palm oil, some in this different sector. And he's comfortable with that. What is yours, and also by extension TradeView's policy on like diversification and even position sizing, which is somewhat linked, right?
There's no policy. I wouldn't call it policy, but it's more like we are mindful of the whole weighting on exposure,
weighting,
right? I wouldn't impose the policy just to restrict, the fund managers for implementing their stock ideas. Right? So if we are positive on, say, consumer sector, but if the policy is in place, like it cannot be more than 20% in the consumer sector, it's not reasonable to me. So it's like if we are positive on certain sector, then I will limit on the exposure in certain stock. Right?
I see.
So stock exposure, yes, I will say maximum 10%, unless we need to go higher than that and we have to specific another discussion. We have to set another discussion and to lay out why,
And how about, let's say, if the exposure was initially less than 10%, but it did well, and then it crosses that.
So we got to be disciplined ourselves to ask ourselves if it has reached the valuation or level that we are comfortable. In fact, if let's say there's still more room to grow, I don't mind keeping it higher than 10%. Yeah, so there's a reason that comes in why we hold that stock higher than 10%. Of course, the 10% came because of the appreciation of market value. But after that, do we consider taking profit? Because are we still expecting more from the company? Yeah, so if we can answer all these questions, then we can raise the rating exposure on the stock. But if it's not, then I think we got to be disciplined and say, why not we start reducing to below? Because the exposure is a risk management strategy to make sure that we don't get too carried away by just good returns. Yeah. So that's on stock, right? But of course, on sector, we also have 25% of a sector exposure. But just in our mind, but it's not so much on policy or written anywhere.
Yep.
It's just basically if the exposure on the sector is too high, then does it match or does it align with what is going on in the market, right? So let's say, for example, if let's say we are now positive, starting to get more positive on oil and gas, then we straight away invest into oil and gas market. And be it positive on oil and gas, but I can't be deploying full portfolio in oil and gas, right? So I will make sure that at least 20%, not at least, sorry, as in maximum 20% is in that sector, unless we really have some good names and like say proxy to the sector, and then we don't mind holding it higher than 20%, then we state why. Are we comfortable with then we will come back to the normal risk and reward analysis again.
Right.
Yeah. So is in terms of percentage wise, you can say like within 10% for stock, and then 20 to 25% for sector, and then we haven't actually gone into foreign countries yet. So what if there's foreign market? Then, but of course that is, if foreign markets comes in, that's when we are talking about asset allocation already.
Yep.
Yeah.
So I do want to talk about macro right after this. However, I forgot to ask you this question. You mentioned earlier on about advantages being in Malaysia, being able to talk to management.
Yeah.
But also, focusing on like the quantitative side of analysis, right?
Yeah.
I find this debate to be very interesting among investors. I see people on both sides. There are some people who say, nah, if you don't meet management, right, you have no edge, right? Because that's where all the juicy details is. But then, here's the cool part. We do know many people, I do know many people as well, who have done well, who deliberately avoid meeting management, right? So they, these are the Casey Chong. I'm not sure if you know him. He's Casey Chong, right? He picked up, FPI, front-end, all this without, just pure desktop research. And of course, Han as well, back in the day, before the TradeView days, he was investing into QL, he was investing in other stocks, Hartalega, without actually meeting them, right?
Yep.
I mean, he read a few articles about it, and that's about it. So this is more of a niche but important discussion among asset allocators, especially in the stock investing world. Where do you sit in this discussion of like how important is it actually meeting management and getting quote unquote either insider information or borderline insider information and getting a good rapport?
I mean, of course, firstly, we are definitely not privy so much on what inside information. It's more on public meeting with the management, right?
Yes.
But I can put your question into two parts.
Okay.
Firstly, for investors who are not looking into meeting management but make an investment, typically they are looking into stocks with good fundamental readings. Yeah. So I mean, for all the ratio or financial standing that it's already
You have
looking
to do the
good
work first.
Yeah. So, I mean, of course, you have to do it first, and then you look through all the annual reports and stuff, and then come up with your own analysis and think that the company is on the is healthy, and then at the same time, their product is not something everyone doesn't know, right? And
Some sort of mode.
yeah, and then you believe that they can carry out their business
Right.
consistently in the far future,
Yeah.
based on historical trend analysis or historical deliveries, of the companies that make you comfortable of investing without even seeing them, right? Because of all the numbers have been already surfaced, and you just have to hold it long term. So this is the thing that the key point that differentiate this answer long term versus the ones who are keen to meet management. Okay. Without meeting management, then you have to carry a belief. You believe in the company, and then you hold the investment longer term, right? But for people who meet management, like for example myself, because firstly, I've been operating in the fund management industry, and that is one of the process that we got to meet, right?
You have to do it.
But why are we meeting management in the first place? But not just because they share something else that no one else do, right? But it's just that they when you meet them, at least you can sense a different gesture from the management, either their way of delivering a message, or you can actually just ask direct questions that you have been wondering by just looking into by just doing desktop research, if you get what I mean. So when you meet the management, then you get a sense of what is going to happen in the shorter run of things, in the shorter term, right? Then actually gives you higher certainty in terms of how people will perceive the stock in the next 1-2 quarters, right? Instead of, I just believe in you and then go into it. So it's actually more of the time frame that you are looking into a stock, right? So for fund managers, especially institutional funds, returns is something also important to be delivered to the beloved clients, right? Everyone is just looking at, within 1 year, how much return you can generate and stuff. By generating the kind of returns, of course, you need higher conviction on the company. When the conviction actually comes from how well you know the business, and how well you know the business, actually, one of the process is to know the management also, right? So, and of course, it actually gives you a more of a shorter term of the sense of a shorter term movements of the share price in order for you to generate the alpha. But of course, I wouldn't say that it's impossible to just invest in a company by just looking into company numbers, which you have stated it out perfectly.
But you're saying it's impossible.
It's not impossible to just look at companies with good fundamentals and then we hold, because ultimately a good company with good financial metrics and also have
It's
been
a
delivering,
reflection, right, of the management.
so you will actually be growing on a say compounded annual growth rate. I mean, it depends on how high is the growth rate that you are looking for, but at least they will deliver consistent growth as long as they carry out their business consistently and also with good strategies. And of course their products is, as you say, got a mode.
Interesting.
So it's the time frame to me. It's not so much on it's impossible. It's not so much on why are we looking at things differently, and it's not because of looking at it differently and give us different return profile, but it's just more on, I mean, for companies, if we know the management and then we know all the pointers from them and we are positive on for the next 2 quarters, what if after that 2 quarters then they suddenly change their tone, then it actually came back down? So in 1 year basis, maybe it just made the 5%, right, by holding it, versus maybe the first 6 months you traded out after you have 20% return, then you trade it out. So it actually gives you a more shorter term alpha. But of course, you hold it longer term, it's fine also. But you only get lesser return profile. But at least you have a different belief on the company and you are more comfortable or just putting your money without looking at it. So the time frame, the attention on the company, that determines on how you want to approach the analysis.
Because I like for me personally, I'm always on this is I'm 50-50 because that has been my experience. I speak to management. Some, like, it's amazing. If only I just listen to management more. But some, a lot of them, they just tell you what they want you to hear.
That could be one of them.
And there's no negative CEO. I've never seen a company CEO, saying, yeah, my company is.
That's why there's this thing that I mentioned just now, which is when you interview, when you have a physical meeting, you can actually sense that from the gesture when delivering a message. Maybe they sound positive, but they actually don't feel positive. You get what I mean?
Right.
So that is one of the points. I mean, of course, by meeting management. Without meeting, then of course you don't have all these doubts or confusions, but you just come back to the numbers.
Fair enough. Okay, so we are approaching the end of the podcast. Just really three more segments. I know it sounds like a lot, but really, I think the first one is, we talk a lot about the past, but I know you're not at liberties to share the positions that you have, but would really love to know what your view is currently on the macroeconomy, and that also ties into how aggressive you guys are, in the fund, right? And then the last time I met you guys, I still remember because you had just raised some funds, and then I think a couple of months ago I met you guys, and you all said, "Well, you only have deployed like 10% of the capital, or something like that."
Yeah, correct.
Right. So how do you all see the big picture right now as far as the economy, all these things?
I think to sum up about the market right now, right, is actually still pretty much a volatile trading market, right? So when you talk about cash holding, yes, we just started in April. In fact, we only starting to deploy in May. Right. So, but we were taking it very slow, and we also invest gradually into some stocks that we actually like, but of course more into the small and micro cap companies. So they are less affected by the global
macro,
side of things. Okay, come back. Then what are we now? We are actually still having quite high cash. In fact, I would say now it's quite balanced at around 50.
I see.
Right. So, but how has it been growing? Well, but why has it been growing from just 10% 3 months ago to now 50%? Because we have been deploying into more and more stocks after seeing management or after analyzing or come up with, I mean, of course, also following our strategy on having diversified exposure into different sectors. So each sector has one or two stocks. Then at least we have number of stocks wise now can be is skewed towards high, because in this market environment, I think it's fair to actually have more stocks to just balance the risk out, right? Because market has been choppy, so there will be winners and losers within the portfolio.
So what does high mean for you guys? What's high to you guys?
High volume.
No. High number of stocks. Yeah.
Oh, to us is to me is looking at around 20. That's high.
Right.
Yeah.
Right.
Yeah. So we are getting there also 20. Yeah, about. But it's only on the 50%. So, but it actually gives us a very comfortable period of time during this volatile market, because year to date, since the beginning of when we start investing until now, total return has actually inched up to about 3% return.
I see.
Yeah. So
which is great, really, because KFCI is down 6% this year, something.
Yeah. So at the moment. So I think one of the positive point is that our time of entry is it's on our favor, right?
Just April, May, right?
Yeah. So but we're actually taking it very slow because we are investing into not so high beta stocks, right? So that actually gives us a slow and steady kind of return profile at the moment, right? But of course, for now.
And when you say high beta, these are stocks that are not. When you say not so high beta, these are stocks that are not too volatile, not really in the news kind of stocks.
Yeah.
Okay.
So but for now, from now until then, what is next for the coming few months? I would say we are still pretty much on the defensive side, but getting more and more positive. Why?
Okay.
Firstly, on the perspective of valuation, Malaysian market actually has come back to a more reasonable level. Of course, I don't jump into sectors, respective sectors, but generally speaking, like KLCI, for example, has actually dropped to fairly reasonable valuation. In fact, quite cheap.
15, 16, right? Something like that.
Forward, we are looking, blended, for the next 12 months, the PE has actually reached about 13 plus. Yeah, it's actually below the average of 15. Yeah, if you're just looking forward. But right now, on a trailing basis, it is about 15. Yeah.
Yep.
But of course, the earnings growth or earnings profile for next year is looking at around double-digit growth because of a lower base. Yeah. So that actually
and
goes
GDP,
down.
as you can see, the numbers.
Correct.
And the corporate earnings usually will lag GDP, right?
Yeah. But of course, it's one of the risks in the market, which is the earnings profile. And of course, at the moment, the expectation has put down a little bit ever since great second quarter result. I would say great because there are more companies that beat expectation than normal. But of course, everyone has started to highlight the risks on third quarter, whether that be impacted by recession, impacted by higher interest rate. The consumption is lower. That actually affects earnings of corporates. So that's why with that kind of risk, especially inflation risk, that would push for faster rate high. That is one of the key risks in the local market.
And that's why you guys are taking it slow. That's the reason.
Yeah. So we are trading in and out here and there. So that's why current invested level could be staying for the next 1-2 months at least.
Yeah.
So we'll just be taking profit from some of the winners, but switching it to some others with some potentials. Yeah. We will constantly evaluate the names within the portfolio. But on the overall stance, it's defensive to turning. Okay, a lot of people actually use cautiously optimistic, right? You are optimistic at one point because of valuation, because things are, of course, foreign shareholding in Malaysia has actually gone to as low as 20%. Recently it's just been 20.2, 20.3, but yeah, generally speaking, it's 20%, which is not high anymore. Compared to like 5 years ago was 26, 27%. So the foreign shareholders are waiting for a good timing to actually came back in.
And political uncertainty also.
Correct. That is the another risk locally that that stops them from coming in per se. So general election timing is very important, right? That actually also trigger. I mean, of course, a stable government after general election will be the point for foreign shareholders to come in, right? And then not only that, our ringgit has actually fallen to now cross
Historic
450
lows.
Yeah, so attractive currency, yes, I would say. I mean, it's just if let's say recovery mode is on the way, GDP growth is still healthy. I mean, foreign shareholders comes in, they can enjoy another, not just from the stock, but also currency upside.
And to give a sense, if my math is right, if it goes from 20 to, let's say 25%, right? The 5 years ago, it was about 26%, correct? For foreign shareholding. So let's say it goes to 25%. 5% of the market cap in Malaysia, you're looking at an additional 50 billion? 50 billion, right? 50, 60 billion in capital.
Which, I mean, of course, for 1 year, I mean, it won't come in 1 year for 1 year, right?
Gradually.
Correct. But that is a significant amount to actually support the market. It wouldn't be, I mean, of course, that actually gives you a sense like, okay, downside could be really limited, right? And now TLCI is around 1,450, as of today. Actually, the further downside would be just the COVID downside, which is 1,002 level, right? Would it trigger that kind of weakness? In my view, not anymore.
Right.
Because there's no incentive for people to panic sell on TLCI. There's no, like, not just because of general election, it's already on the table. It just went, right? And then valuation is already cheap. And then earnings growth, although there will be some risks and for downward revision, but generally speaking, it is still one of the beneficiary of weaker ringgit because of export-driven manufacturing. And then but what offset the positive would be the consumption locally, because of inflation, everything's are going up and stuff. But net, it would just be neutral for growth on GDP side. So maybe it's just some adjustment on valuation comes with some upside potential in terms of earnings surprises. Then that is good for people to relook into Malaysia.
So if I summarize, of course, in investing, like, I think far too many people want to just be in one bucket. I'm bullish or I'm bearish. But the thing is, things are very balanced and nuanced sometimes, right? And if I summarize, your viewpoint is bullish because, one, foreign shareholding is all-time low. Two, what's the word? The ringgit is very cheap. And three, the valuation for the KLCI is at historic, or at least below the historic average.
Below
average. The forward earnings, right?
Forward earnings,
But the risk is that inflation doesn't taper off and interest rates needs to go up. Which means obviously equity markets will tank.
Interest rate hike has already been also what people is expecting. It's just how high, right?
Correct.
And for Bank Negara to actually raise interest rate, one of the reasons is that to close the yield gap between US and ourselves, because to protect and support our ringgit. Otherwise, our ringgit will continue to fall, right? And by raising interest rate, that doesn't really help spending on from corporates because of higher debt. So that's why when we read this sort of macro data, then we will be more selective in companies that we invest. Like, say, we don't invest into companies with high debt, and we also
uncertain growth, right? High growth typically.
Correct. And also we don't really look into companies that focus into domestic market so much. Maybe more towards the export market. Like, that's why you can't run away from technology. But it's just that when are we deploying more into technology sector? Because technology sector is a bit of a mixture at the moment. At one point, affecting by global market noises. But on the other hand, it is also slowdown of demand, supply. I mean, of course, the changes in the supply-demand economics because of recession, right? But we are benefited because of weaker ringgit. So net is just kind of offset, right? but locally speaking, technology sector valuation hasn't really reached to a very attractive manner. It has fallen, but it has fallen to just maybe 5 years average valuation kind of thing. So I would just wait for a while longer. Yeah, that sort of things. So, but after saying all this, technically we are also in the direction of deploying more and more cash into the market, because I think the positive more outweigh than the negatives. It's just the only near-term hiccup is the general election timing of it.
Right, and it sounds like, I'm not sure if you can say this, but it sounds like you would prefer a government very similar to the pre-2018 times where things are more stable.
Well, it's a general saying that pre-2018 government, it's more business-friendly government. So yeah, I think that it's also not just myself, but quite a number of people on the ground expecting that to happen as well.
Yeah. Interesting. Okay, just to top up all this, I know that there are a lot of new things happening, right, with TradeView. You all have completed your first round of raising funds for the current one, but you are starting something new as well, right? You want to share a little bit about that?
Of course, previously we have been focusing mainly private mandates, discretionary portfolio for high net worth individuals, be it, or corporates, and that is more of it's more like one-to-one bespoke service to our investors. But right now we actually looking into another channel. Basically we have a fund, a wholesale fund that is catering for more mass market. I think what differentiates between this private mandate versus wholesale fund is that the entry level for for wholesale fund is a lot lower. Because we are actually talking about entry level of 1 million and above for private mandate discretionary versus 50,000 for wholesale fund, right? So, and the structure of wholesale fund pretty much like unit trust, but wholesale fund, why is it called wholesale fund? Because it's only catering to sophisticated investors, which meet certain criteria, like say high net worth, investor profile. Like, one of the criteria could be if you have gross income of 300,000 and above.
Or net assets of 3 million, excluding
your primary residence, right? So you need to meet certain criteria in order to participate into wholesale fund. But we have one. It's called the Sustainability Fund, which also have the additional consideration on our investment, which is related to the current theme, ESG. So, of course, the fund, it's eligible to SC. Point of view is that it's approved by SC as a sustainable and sustainability and also responsible investment, SRI they call it in short. So it is one of the requirements for us to submit to SC for us to when we invest into ESG related stocks lah. So this wholesale fund mainly has that additional consideration when you come for stock investment, but nonetheless the mandate can be also quite general and flexible. We can consider anything within the universe. Because we also have our own proprietary analytics or metrics on ESG that we can consider any stocks that is not covered by let's say bigger providers like FTSE, Dow Jones when it comes to ESG investments. Because like for example FTSE has the FTSE for good index. And inside the index, there are about 200 over stocks. And those are the stocks that have been evaluated by FTSE that they are considered as ESG. But what if those names that are not in that index, right?
But I mean, if I'm not mistaken, also there's like 20 to 25 different standards of ESG right now, right? There's nothing...
It's very broad at the moment. Definition is not really clear, but it's actually up to each fund houses to actually... have their own metrics on their evaluation. I mean,
Right.
be it, even ourselves, we have our own ESG metrics. Yeah, but of course, we have to go. We are going through the process which SE is comfortable with. That includes also negative screening of stocks, and then the next stage would be positive screening on certain stocks. Negative
Right.
screening meaning any sectors that we actually put in, we will not invest. Positive screening is when we have additional points, being assigned to certain stocks, and whether does that meet, our internal guideline in terms of ESG scoring. So if the scoring doesn't, let's say out of 10, if the score that doesn't go above 5, then we would not invest.
Interesting.
Yeah. So and then ESG, basically our metrics has 5 elements for each pillar. Like environmental, we have 5. Social, we have 5, and governance, we have 5. So basically, we are quite balanced in that sense to consider all aspects. Yeah. So like governance, we will actually make sure there will be diversity in the board composition. That's one of example. Like social, whether do they have any forced labor issue, and then environment, whether the main thing would be carbon emission standard, whether they fulfill or would they have planned to fulfill. So we actually take into account companies that working on implementing ESG plans also. It's not like we exclude straight away until when you have something to fulfill, right? So if you have planned, then we will evaluate more and more on a periodical manner. Like every semi-annual, we'll come and revisit again whether have you fulfilled, and if you are in progress or fulfilling, then yes, it's also part of our investable stocks. Yeah.
And do you think that it's gonna help with the returns? Because I think people who disagree would say, well, it's all nice and all that, but some of these rules are subjective and they can actually hurt your returns because now you exclude a lot of potential, right?
Yeah. That's what the point that I want to stress on is that we actually take into consideration stocks that other people are not considering. Meaning, it's not being evaluated doesn't mean they are not investable, but it's just that as long as they can go through our proprietary analysis or analytics, then they can be part of our investment portfolio. But to answer your question, whether does it affect the return profile? I think this is more of a longer term consideration.
Yep.
Because our funds generally also looking at a more longer term horizon. Our philosophy is actually more on a company with high quality, and then we grow together with the company to actually be bigger. That's why we see our focus is actually small to micro cap company, because at one point they will be growing, right? So another point is that it's more of a longer term consideration when it comes to ESG, because firstly, yes, the cost has to be spent on implementing all these measures. So it's actually a cost to a company, but they may actually face greater premium in terms of valuation being given to stocks like this, because when ESG is in place, that's when a lot more attention from investors, be it domestic or even sometimes if let's say a stock that is in foreign shareholders' purview, radar, then they actually would consider this stock because there is an ESG element in it versus the rest which are absent, right? So valuation premium will be given. So technically that offsets some of the costs on the earnings side, possibly. And then another thing is for the greater good of the society. So with the ESG being implemented in the longer run, it will be more. It will lead to a more cost effective or cost efficient business model for the business, and of course there will be less scrutiny from either be it from the regulator side or from the society side on the business once they are implemented properly in terms of ESG. That's what in my opinion. Of course, that is not so much on the return profile. I think it's just more on the horizon on when you see it through, whether the ESG impact really comes in, that really matters when it comes to execution of the company lah.
Right.
But
Okay.
of course, this fund, if for more details, of course, we have our website and then the information is all there. But bear in mind is that for wholesale fund, of course, the management fee is about 1.8%. Then there's also a performance fee element in it. But of course, entry point for any of the investors that do not want full exposure in the private mandate side, we can always consider a smaller entry to wholesale fund. Yeah, but going forward, we'll also be considering a few more funds that is on the way lah. Yeah.
All right. Looking forward to that, definitely.
Yeah.
Well, Nixon, it's always a pleasure talking to you. Wish I can speak more. And,
Yeah, it's really a pleasure. So
sorry we had to cut, we call it to an end. But all the best with the funds. Really looking forward to you guys making waves as I would say a pioneer in the ESG fund management space.
Yeah,
in
we
Malaysia.
are.
You are a pioneer.
In the boutique fund management industry,
Yeah,
yes.
I mean that. Yeah, just wish you guys all the best.
Thank you so much.
All right, guys, if you enjoyed the pod as usual, like, comment, subscribe, and follow us on Spotify. And if people want to find you, where can they find you? If you want to be found at all.
We'll be on our website. You mean
Website lah.
Yeah, website, correct.
Right. But you personally, maybe you got some fans, I want Nixon only. I don't want Han.
No, I think everything will be on our website. Yes,
Okay.
correct.
All right, man. Thank you so much for coming. And guys, we'll see you in the next podcast. See you.
Thanks, MJ.